Hey everyone, John Hopkins here with your weekly housing market update. Let's dive into what moved the market last week, why it happened, and what's on deck for this week. So here we go. Let's start with mortgage rates. The 30-year fixed is at 6.96, which is a drop. The 15-year fixed is at 6.41, and 30-year FHA is at 6.33, down almost an eighth. Rates fell to 2-month lows despite early weak inflation concerns. So what were the drivers of that? Well, we had some retail sales shock. Retail sales dropped about 0.4% versus a forecasted 0.3% growth, the largest miss in years, which is signaling weaker consumer demand. The producer price index unexpectedly showed lower inflation pressures, fueling optimism for rate cuts. So we saw a bond rally. The 10-year Treasury yield dropped, pushing mortgage rates lower as investors reacted to the weaker economic data. So why did this happen? Well, in plain English, retail sales weakness reassured markets that inflation could be slowing, driving bond demands and lowering yields. Mortgage-backed securities rallied, bringing down mortgage rates. Short covering ahead of the long weekend also played a role in last week's rate movement. So what's on deck for this week? Well, we've got a big week ahead with several key reports that could impact mortgage rates and the housing market. So here's what to watch for. So tomorrow, February 21st, we have housing starts and building permits. This is going to be a critical look at new home construction. If we see strong numbers, it means more inventory is on the way, which could help ease pressure on home prices. This Thursday, February 22nd, we see the jobless claims report. This is a key indicator for the labor market. If claims rise, it could signal a cooling job market, which might influence the Fed's stance on interest rates. We also see the Philadelphia Fed Manufacturing Index. This report gives us a pulse on business conditions and inflation pressures in the manufacturing sector, which again gives the Fed a little bit of directional information. February 23rd, we see our existing home sales, one of the biggest reports of the week. It's going to show how the market is holding up and whether higher rates are slowing buyer activity. We also have the S&P Global Flash PMI. This is a leading indicator of economic activity. Markets like to look for this to see signs of strength or slowdown, both in the services and manufacturing sectors. So what this means for you? Well, if housing starts are strong, expect a gradual increase in inventory, which could benefit buyers. If jobless claims rise, we might see more speculation about Fed rate cuts, which could help mortgage rates in the long run. And if existing home sales slow, it could be a sign that affordability remains a major challenge for buyers. Will buyers respond to lower rates? And the 10-year Treasury yield is testing a support level at 4.34, and a break below could push mortgage rates even lower. So what does this mean for you? Well, buyers, rates are trending lower, making it a great time to lock in a rate if you're shopping for a home. Sellers, expect more inventory to hit the market as we move into spring. Pricing competitively will be key to attracting buyers. That's your Market Pulse update. Stay informed, stay strategic, and let me know if you have any questions. Take care, everybody. Bye.